Hello, this video will describe in detail the spreadsheet you prepared last week for Gemini Electronics. Again, this is not a tutorial on Excel. If you need help with Excel, you can find some great tutorials online. I may have highlighted some sections of your paper in blue. This indicates that it wasn't necessarily wrong, but just different from what we'll be using for the final written analysis of Gemini Electronics. Different analysts use different variations of the ratios based on the industry, their needs, the audience, or personal preference. I understand this can be confusing for new finance students, but it is the reality. You will notice the biggest difference on your ratio page in what you probably did and what we will use for the final analysis. This had to do with using year-end versus yearly average balances. You will see how that works later. Both methods are correct, but unless there is a standard agreed upon standard for your audience, you must describe what you are using to be absolutely correct. Let's start by looking at the raw data. The raw data is usually what the customer or subject company has made available. This usually is comprised of an income statement and balance sheet, and if you are lucky, a cash flow statement and maybe even a statement for retained earnings. The raw data presented in this case is probably more than you will normally receive. Most analysts look back 5 years or more, more or less, depending on the situation. In most cases, you will receive 5 years of individual's financial statement. Your job as an analyst would be to spread all of the statements in the format that's been presented to you in this case. So, believe it or not, you have a head start on Gemini Electronics. The raw data is typically spread in a standard format for the audience you are preparing the analysis for. Banks may have one format, investors another. Google Finance a completely different format. The idea behind a standard format is that all subject companies' financial statements being analyzed will look somewhat similar for quick and easy reference and review. Most of you did well on the scaled, trend, and common size statement. We'll take another look at these for review and reference for the future. Let's move on to the scaled down statement. In part 1 of the video, I explained that it's difficult to analyze and write about numbers that have 10 to 15 places. In the Gemini case, we are working with billions as the largest value. We can scale this number down by dividing by 1 million. We can do this with the formula you'll see me enter now. Reference the raw data, and then divide by 1 million. And we'll give an absolute reference to this so that we can copy it through to the other cells. We're going to go ahead and format this area for 1 decimal point. You should be able to copy and paste this formula into other cells to complete this statement format. Be careful when copying and pasting, as the exact data as the raw data may not be in exactly the same order as the scaled down format. We'll see an example of this in the common size statement. The trend statement is intended to present changes in account balances from period to period over the 5-period review. We are calculating year-over-year changes in this case, but you can do this for any period as needed. The trick is here that you cannot calculate these values for the first year in the review period. First, reference the most current year in your review period, and then subtract by the previous year. Now this is the difference, but this is not what you want. Go back into your formula and put these in parentheses because you're going to be dividing this difference by the most current year, and that would give you the change. You should be able to copy this through to the rest of the years down the column. Now notice when you go into the next year, you'll have to change your formula because you're not lined up with the correct year references because of the change column that exists here. You should be able to copy this formula across rows and down columns carefully. You'll notice that on this format, we've also added EBITDA, operating profit, earnings before taxes, and net income, subtotals, and totals. This is so that it will be easier to calculate formulas later when we get to the ratio page. The next is the common size. The way this is calculated is to take each item, and you can go to either the raw financial statement or to the common or the scaled down to get your values. And then for the income statement, you want to divide each item or each account by sales. You'll notice that we should probably also format this by percentages with 1 decimal. And then you should be able to copy this over, should be able to copy this down into other cells. And there you go. Now if we were to copy this over across the row, you'll see that we get odd numbers back in return. What you need to do is reference the sales column by just hitting F4 one more time. That will allow you to copy this across, paste it, and then you should actually be able to copy this formula into the rows as well. The industry numbers came from Exhibit 4. We'll move on now to the ratio page. On the ratios, what we are going to use in Gemini may be different from some of the formulas that you found in the text, or I should say the readings, or you may have found from other outside sources. I've put an abbreviation of each formula in this column that you can follow along with, and they will be different than what you may have used, and again, not necessarily wrong, but different. So the first one is the current ratio. That represents current assets divided by current liabilities. And I'm just going to show you a couple of these, how to reference them, and then I'll let you do the same for the rest of the ratios. So we go into our balance sheet, and I'll go to the raw data because I don't have the scaled down completely filled out. I'll pick up current assets and I'll divide by current liabilities. And you'll see that the answer is 2.2 times. That means current assets can cover current liabilities 2.2 times. For the quick, what we come up with is current assets minus inventory minus PP, which stood for prepaids, over current liabilities. The cash was cash plus marketable securities, of which we had none on this balance sheet, divided by current liabilities. So in this case, it would have been cash only over current liabilities. The next section is asset management. The first one that I'll show you how to do, most of you did this based on a year-end account balance for AR. That's fine, except in my mind, the credit sales are part of the income statement. And you remember that the income statement tells a story over the entire year's period, where the AR comes from the balance sheet and only tells a story at year end. If you use the year-end balance, there could be some seasonality or other issues that are skewing that number. So I think it's a good idea to take the average AR by taking the year-end balance from the previous year and the ending balance from the year you're analyzing and come up with an average there just by adding them and dividing by 2. Let me show you what I mean. We're going to first go in and pick up the credit sales, which in this case are all sales, for 2006. And then we are going to divide that by the AR from 2005 plus the AR from 2006, average it by dividing by 2, and you'll see that our AR turnover is 10.06, and that means the sale or receivables were collected in a little over 30 days. Well, let's calculate that precisely, and we see that the formula for that is 365 divided by the turnover. You'll see that 36 days was our collection period. Again, you can do the same calculation for inventory turnover using cost of goods sold over average inventory, and then divide 365 by that number, and again average AP, and then average fixed assets. You see that there's no numbers in the 2005 column because we cannot get an average of 2005. Moving on to debt, the first one is total liabilities over total assets. So some people thought this should be 1. The only time it would be equal to 1 is if there were no equity in a balance sheet. So it's total liabilities divided by total assets. We go on to long-term debt over equity. I'll show you this one because the trick here was that long-term debt consisted of both the short-term piece and the long-term piece. I'll show you debt over equity, the current portion of long-term debt, and long-term debt divided by equity. So where you may have gotten tricked up here was in not including the short-term portion of long-term debt. Most people had no trouble with the times interest earned, which was the EBIT. EBIT we picked up from this number here, which is also known as operating profit. Most people had easy time with gross profit over sales, operating income over sales, and net income over sales. Again, here we have ratios that a lot of people calculated using the year-end total assets. Again, I believe it's better to use the average total assets, which you can calculate by taking the current year plus the previous year divided by 2. And then average equity, again, that's what many people use this or calculated this using a year-end balance, and that would be fine as long as you describe it. Again, I prefer to use average equity, and that's what we'll be using to analyze Gemini Electric going forward. I am going to review with you now what the final worksheet looks like for the written analysis on Gemini Electric. Again, I'll be sending this out immediately, and this is what you will use on your final written analysis. Looking at the scaled down data, you can see that all the income statement and balance sheet are completely filled out. You can see that the trend statements are completely filled out. And you can see that the common size statements are completely filled out. Now, most of you did not have a problem with this, but if you had some cells that were incorrect, a good way to figure out what happened is to click on the cell, hit F2, and you can follow this formula through. What this says is if you go to the scaled down formula, the 000s, cell B5 divided by cell B4. And that's a way to track back where you might have made your error. Just to show you what I was talking about earlier, that it shouldn't make a difference if you use the scaled down or the raw. Let's do this same thing but using the raw data this time. So we'll go back and use these large numbers, raw data, cost of goods divided by sales, and you can see that it comes out to the exact same answer. That's because of the fact that we're only going down to 1 or 2 decimal points in our answer. And now you'll see the ratios, and what I've done here is also give you an explanation of that ratio and some hints as you may be starting your analysis, but I'll cover that in more detail when I go over hints for analysis with you in the next video. But you can see that if you had one wrong, let's take one of the ones where you had to use an average so you can see what that looks like. And if you hit, oh, we got to get into the right cell. We'll do 2006 AR turnover, and you'll see that the formula was raw. I used raw here. Raw financial statement C3 divided by the average of C25, and you can track those items right back to the statement or to the other tab where these numbers came from. So by going through and clicking on each cell, you can find the formula here in this bar and be able to track it back on your spreadsheet. The next video that I'll prepare will be the tips and techniques for starting your analysis using all this data that we now have available.